I don't want to waste everyone's time if it's easy. Okay. Well, if anyone wants to go over it after class, I can. I'll just continue to go then over the theory. So let's talk about the perpetual system. So the perpetual system is a bit different because it's still going to be our gross profit here. The reporting doesn't change. It's just how we account for it changes, that we have to do the counting rather than we get to know what's automatically in the system. And so each sale of merchandise involves revenue and a cost, right? Revenue is recognized when we are expecting an asset from the customer, or we're expecting cash or accounts receivable. And then the recognition of cost is when we sell the merchandise. And so let's look at it from the revenue side of things now. So revenue side, we're going to look at when we sell the asset. So let's say we're gonna sell assets or sell inventory on receivable or on credit. Our accounts receivable or asset is gonna go up 1,000 and our sales will go up 1,000. And then our cost of goods sold at the same time will go up 300 and our inventory will decrease by 300. That's the cost of our inventory. Our gross profit from this will be 700. So at the same time, we have two journal entries. If you miss one of these, you don't have a correct answer. Right? At the same time we sell it, we have a sale and a cost booked at the same time. You can book them separately or the same. There's a revenue side and a cost side. So what if we have a sales discount? Right? So instead of us having a purchase discount, let's look at a sales discount now. How would that affect our revenue? So now that we're selling the inventory, let's say they pay with the discount period. So we get cash of 980. We have a sales discount and accounts receivable. Our accounts receivable is always going to be decreased by the other side of the accounts receivable. And our sales discount will be the 0.2% or 0.02%. And then our cash will be the difference that we collect. Now, what's this account? Sales discount. This is going to be another contra account. Remember we talked about contra accounts for accumulated depreciation? This is a contra sales account. It reduces our sales value. And so it will be considered a sales account, but it will have a debit normal balance instead of a credit normal balance. So this sales discount, if our sales were 1,000, our sales discounts are 20, our net sales are 980. We'll have a credit balance of sales of 980. We just went over that. Same thing now, we have to worry about sales, returns, and allowances. So what if we, from a selling side of things, what if we do a returns and allowances? This is just the other side. We worried about purchases before, right? We're going to talk about purchasing and we're going to talk about selling. Talked about purchases before, now let's talk about selling. And now what happens if we have returns? Well, we're going to have sales returns. Oops. Sales returns, so returns and allowances. I'll let you do the Google Sheets just so we can save some time. But the sales returns is 15 and the cash is 15. If the goods are not defective, so if we get the assets back, we'll increase our inventory because we can sell it again. If they are defective, we're going to take a loss on that inventory and decrease our cost of goods sold. So let me focus on this. This can be kind of complex, right? So let's think through this. Does this make sense? And I'll let you all ask questions. So if they return merchandise which sold for $15 and cost $9, there's two pieces here. we have to fix the sales side, our revenue side, and we have to fix the cost side. Does that make sense so far? We have both sides. To fix the sales side, we give back our cash, we credit cash, we give it back to the customer, and we debit sales returns and allowances. This is another contra sales account, similar to what we just talked about, discounts. So our sales will go down $15. Now there's two scenarios here. What if some of those goods, with those returned goods, were fine? And the cost of those goods were $9. Well, we can just add it back to our inventory and reduce our cost of goods sold because we didn't have that cost anymore, right? We just add it back to our inventory and reduced our cost of goods sold. Well, what if they are defective? What if $7 of them are defective? We can no longer call that $7 a cost of goods sold because it would affect our margin. And we have to call it as a loss. Losses are actually just expenses. The reason we have to do that is classification. Investors have to understand the difference between your profit and your income. And so the loss wasn't related to you generating revenue. And so we're going to move it to just another expense. So I know this is a lot, but just memorize that there's always the two sides and focus on the not defective piece. But just understand that if there is a defective piece, we can't include that in our cost of goods sold. And same thing here. If we just offer, the question here is, what if we just offer a price reduction in order to keep some of the defective product? We'll just treat it like a discount, right? We just reduce our sales, give them back cash. Debit sales allowances, debit the sales account, credit cash. And here's another example, which I'll save for the next section of class for whoever wants to go over it. So at the end, we have our accounting cycle, right? That we've talked about a few times. The accounting cycle where we have to look at transactions, analyze those transactions, book them to our journal entries, and then close the books. Then we make an adjusting journal entries. Then we do our post-closing trial balance. Then we post our income entries and so on and so forth, which I asked you to memorize in the last class. So we're going to have adjusting entries related to these merchandising transactions. This looks more confusing than it is, right? Whole concept here is, hey, we buy stuff. We have stuff at the beginning. We buy it. That's what we have available for sale. Whatever is left in our ending stays on our balance sheet. That's in our inventory account. And then whatever we sold goes to our cost of goods sold, which is on our income statement. And then our ending inventory is always going to be the next year's beginning inventory, right? Or the next periods. And so on and so forth. This goes on in perpetuity. So at the end of every period, we might have to do adjusting entries. Now, I'm going to take this back. I'm talking a lot of accounting lingo. This is really a simple concept. Think you're running a store. We're selling. Let me see. Think you're running a store, and so we're running a store and we're selling shoes. Well, we're selling shoes, and they have QR codes. They have barcodes, and we've sold 1,000 shoes. We started with $100 of shoes. We ended with $1,000 of shoes. We purchased shoes throughout the year, and we sold a certain amount of shoes throughout the year, right? That's all we do. We start with some shoes for our business. We buy more, we sell some, and there's some left over. Simple. Like, try to keep it always, there's a lot going on here, but it should be simple at the end of the day. We're just buying stuff. We have stuff at the beginning. We might add to it. We might subtract from it through sales or returns. And then there's just an ending amount. Well, that ending amount, it doesn't matter what our systems tell us. It matters how much we actually have on our shelves, right? And so we need to count that at the end of every period. Because why? Because people steal, because sometimes things go missing. Sometimes some things get broken. And so what we do is at the end of any period, we'll count the shoes. And then we see how much we have left. And so if we count at the end of the period, oh, I thought we had $750 of shoes, but we actually only have $500 of shoes. We need to make an adjusting journal entry to accurately reflect how many shoes we have on our shelves, right? That's all we have to do. That's the point of accounting, to make sure that on our balance sheet, everything's correct. That difference is just going to be called an adjusting entry for shrinkage. Shrinkage is a nice word for saying, hey, someone probably stole it, or we lost it, or someone messed up. And so cost of goods sold would increase and our inventory would decrease. We treat it as a part of cost of goods sold. So that's an interesting thing that you should know now, is most of the time when you go to the grocery store, your costs are probably about 50%, 25 to 50% higher because of shrinkage. They charge you more because people steal and because people throw things out or damage goods, right? So you're paying more because of that shrinkage. So a way for a good manager to manage that is to make sure they have the cameras and make sure they have all these other pieces, and they're doing good inventory management to make sure they're not losing goods, because it gets passed on to the consumer. So new revenue recognition rules require the sales. So this is my area of expertise, and it's just important to know here that revenue is an extremely complex and extremely high risk area for accounting. Anytime you look at stocks, people talk about earnings per share. Earnings per share is based off revenue. And so I'm a revenue subject matter expert here in the Bay Area. And one of the complex things of revenue that they've made a new law on is even if you are collecting a certain amount, you're selling a certain amount, you're only allowed to recognize revenue based off of your total expected amount to collect. So just be aware of that. So even if I sell $1 million of product in a year, if I know that of that $1 million of product, I'm going to have to return $100,000, I'm only allowed to recognize $900,000 of revenue. And so we'll have to make an adjustment every year for the amount that I expect not to collect, or I expect never to receive. I'm not going to ask you to do those journal entries. Just know that's a law. That's a rule, that companies can no longer recognize revenue unless they expect to collect it. And so if you expect discounts, returns, anything like this, you're going to have to adjust your revenue for other adjusting journal entries. And then we go through our closing entries. Our closing entries are, before I go to closing entries, is there any questions? Let me pause the recording.